Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. In investor circles, private credit seems to be the topic du jour. It's really taken off as an asset class recently, but I reckon many people would be a little unclear as to what it is, how it works, and what it means for investors. So today we're getting a 101 on private credit, the benefits, the risks, the opportunities, that type of thing. Remember, this is general information only, and you should seek professional advice before making any investment decision. David Ingram is the co-founder and CEO of CrowdProperty Australia. CrowdProperty Australia, a great supporter of this podcast. David, welcome to Fear and Greed.
Hi, Sean. Great to be here.
So let's start at the very beginning. What is private credit?
Oh, private credit is a great way of investing to get a fixed income without the volatility of other asset classes like shares. And you can get great returns at the moment as high as 10%. So they're attracting a lot of interest. And that compares, with what you might think of a traditional fixed income benchmark as perhaps the Australian 10-year bond, which peaked around 4.95%. So some really good returns in this space at the moment.
Okay, so when we're talking about private credit, though, an easier way to think, so it's loans that aren't from banks. Who is it? Who's doing the lending?
I think private credit can be confusing for people, so it might be worth tackling what credit means for people. It's sometimes used interchangeably with debt funds. Debt can be seen as a negative connotation for investors, but typically it's thinking of investing as thinking of yourself as a lender. And you're lending to small businesses or corporations, helping them grow or manage their cash flow. At CrowdProperty, we're a specialist investment manager, and we facilitate lending money to experienced property developers to help them build more Australian homes.
Okay, so in the case of CrowdProperty, I, as an individual, can use my money with CrowdProperty. You bunch it all together with a bunch of other people providing money, investors into your fund, and then you're on lending that to do exactly what you just said. Is that right?
Yeah, absolutely. We bring diverse sources of capital. Everything from retail investors can invest on the platform through to institutions who like residential Australian property, but these projects are too small for them to warrant doing their own due diligence on. So absolutely, you get pooled with other investors into individual loans, or you can come into a pooled fund and get those high yielding returns. Our current CrowdProperty Partner Fund pays about 10.5% per annum on a quarterly basis.
Okay, so just before we get into the crowd property funds, are retail investors heavily into private credit? Is it mostly the big super funds? Is it other wholesale funds? Who is it that's providing the private credit mostly in Australia?
Yeah, private credit is definitely opening up. I'm very excited to be able to bring this to a retail proposition. It's traditionally been the preserve of, I'd say, wealthy individuals with a lot of time on their hands, the high net worth investors, the wholesale investors, and obviously institutions who've been in this place. So the non-bank lending space, which is the typical path for investors to invest through, is very opening up. Here in Australia, we're still somewhat behind Europe and the US, where I think in the US, non-bank lenders account for almost 50% of lending commercially, compared to about 10% in Australia.
And so the flip side to that, in your case, it's residential property, but it might be a small business, or it might be they can actually access funds without having to go via their bank. Is that right?
Absolutely. So, borrowers who are looking for kind of the speed, ease and certainty, which they can get from working directly with specialist lenders, and private credit encompasses all sorts of things from small businesses looking for cash flow around, paying for their invoicing, through to what we do, which is lending to specialist property developers to build more homes. So it could be other assets within that. It could be getting finance for capital goods you need to buy in your business. There's a whole range of things which private credit can mean.
Stay with me, David. We'll be back in a minute. I'm speaking to David Ingram, CEO of CrowdProperty Australia. Okay. Now, up front, you said that it's kind of a less volatile, stable income. How does it work? So let's say I've decided I'm going to put some money into a CrowdProperty fund as a retail investor. I'm putting in $100,000, $1 million, pick whatever it is. I'm getting paid an income stream. How regularly, and where's the income coming from?
Yeah, so effectively, you've got to think of yourself here as a lender. So you're lending to a small-scale property developer who's typically pays the capital and interest back at the end of the loan term. So these are short-term bullet loans, typically up to 18 months. At the end of that period, you will get your your interest and your capital repaid. The alternative is to go into a pooled fund, which simply spreads your investment across the entire portfolio of first mortgage secured loans. And for that, you can also earn a quarterly interest payment, which suits people, particularly as they're heading more to that sort of retirement phase.
Yeah. Okay. So what sort of investors? And I rush to tell our listeners that you should always seek professional advice yourself, and you need investment advice fit for your circumstances. What typically does this sort of product, or who typically does this sort of product suit?
So private credit is very good in terms of not just giving you a regular income as discussed, but also in potentially a defensive play. So as part of a broad portfolio of products, you might look at something generating an income which isn't necessarily correlated to other assets you might have in your portfolio, such as shares. So it can provide that stable income return. People who like the nature of the short-term funds, we have projects which run from as little as 6 months to 18 months. So it suits quite a range of investors, those who are starting out on their journey, perhaps who can't get a foot on the housing ladder, but like the fact that the end product they're investing in is actually building more homes, through to those who are retired and looking for that regular income stream. So it's pretty broad, our investor base. And that stems from retail investors, as you rightly said. You can invest from not $1 million, but $2,500 is actually the starting point.
What about the risks then?
So when you're looking at private credit, the asset classes probably are defined by where they sit in terms of the security offered and also the seniority within that. So what I mean by that is security. We always take a first mortgage, which is secured by real Australian property. This is value-adding property, which is usually being developed or renovated. Just like the bank takes over your home when you take out a mortgage, they're the first to get repaid when you sell the house. Now, it doesn't matter whether when you sell the house you realise a capital gain or not. At the end of the day, you have to pay back the bank. So that's one way we de-risk it. I'd say the other way is through the experience of our team. So our team are all highly specialised. They've all been doing their own property developments, or they've been architects, or they've done both. So they're able to evaluate deals as they come to us and select the best ones. So to give you an idea, we only select about 4% of all project loan applications for our investor to invest in. Once the loan goes live, we also manage those loans very closely to make sure that at the end of the day, our investors are getting their capital interest repaid.
Okay, and what's the experience been like over the past 6 months or so? I know private credit has become more popular, or at least we're talking about it more through the interest rate cycle. Have you seen a lift or a significant lift in arrears?
Not in arrears, but we have seen a significant interest from investors coming in. I think as people, as you rightly say, interest rates are at high, many think they're at their peak. And certainly we're seeing a lot of interest from the likes of family offices coming into this space. They can see this is the opportunity to get into this market. I think they're buoyed by seeing, house prices, which have been increasing over the last 14 months across all the capital cities. I think they've gone up just this month in all capital cities bar Darwin. So there's certainly a lot of interest in both the private credit side of things, but also in the residential property side of things. So we've seen definitely that unlocking at the start of this year compared to last.
The other thing that things like private credit do is put more competition into the market, David.
Absolutely. I think generally our small-scale property developers and builders have been woefully underserved by the banks. The banks pulled out of this space a number of years ago, which is why we've seen the rise in non-bank lenders. And I think this is the same across other private credit categories. So you're right, there's more opportunity. It means we can provide a better service for our borrowers, and it creates more opportunities on the investment side for, I guess, a category which has traditionally, as I said, been the preserve of the high net worth and the institutions in the past.
Okay, so if listeners are interested, what's your website? Where's the first starting point?
Go to crowdproperty.com.au.
Fair enough, do that. Of course, make sure that it does suit your own financial circumstances. Do you think this is an area or an asset class that's going to continue to grow?
Absolutely. As I mentioned, we look overseas and we see, this non-bank lending space represents about 50% of the US market, about 25% of Europe, and only about 10% in Australia. It's growing rapidly. I think about 15% compounded year on year is the growth we're seeing in this space. So yeah, without a shadow of a doubt, we're seeing KKR's recent family capital survey has shown that private credit is the asset class where most family offices are looking at increasing their allocations in 2024 compared to they're actually looking at pulling back on their equity side of things. Not to say they won't stay in equities, but we're seeing a balance shift, that's for sure.
David, thank you for talking to Fear and Greed.
Thank you very much. Great to be here.
That was David Ingram, co-founder and CEO of CrowdProperty Australia, a great supporter of this podcast. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.